All right, guys, we're here for another Whale Club Radio episode, episode 10, and we're doing a little different today. We actually have some TA and chartist expertise on the show today. Once again, you can find all of us over on the Whale Club TeamSpeak server ts.whaleclub.co. I'll include that in the show notes. So without further ado, we'll go ahead and introduce our guest. That's Danny Jassy, otherwise known as SpyderCrusher. He's very active on the TradingView chat, and he's designed some proprietary software that's very useful for us as traders that doesn't have the same components of moving averages and such like that. So I want to go ahead and turn it over to Danny, and just why don't you just kind of tell us a little bit of your background, and then how the origins of the SCMR trends, which is your proprietary software, came about.
All right. Well, thank you. I appreciate that. And one sec.
Okay.
All right. I guess I had it on in the background. I was wondering. I was hearing your voice twice. Anyways, small glitch, but not to be unexpected. Anyways, my name is Danny Jassy. I'm from SpyderCrusher Market Research, which is a company that I made to deliver research to individuals, institutions, portfolio managers, basically people who are trying to make the most return for their assets. I want to thank TradingView, one, for basically allowing me to put my software out there, and also BTC VIX and whaleclub.co for having me today. And of course, all my friends watching. So I hope you guys are going to enjoy this presentation. The main gist of the presentation that I've prepared is how do you reduce risk, number one, and how do you find good trades, number two. So if we can accomplish either of those two things, then we're basically doing our jobs as traders, as risk managers, and that is really the goal. So the software that I'm going to be showing you guys is basically the number one product that my firm sells. Is how to essentially find good ideas and then execute them. So our motto is your best ideas, our best execution. And essentially what we're trying to do is give you a means towards lowering your cost basis and lowering your fees while also getting higher risk reward. So that's that. My background, I graduated with a degree in accounting, and I actually like accounting a lot, which I know is weird, not something you typically admit in public, but I do. And when I first graduated college, I met another guy who was a former IB, basically banker, salesman, and he was really into algorithmic trading, and he had set up a prop firm, and a prop firm, if you don't know, is where you put up some amount of capital and you trade through the firm's capital, which gives you higher leverage. In equities, you're typically limited at 4 times, and they would give you a lot more. So my job was to help test and evaluate their algorithms, and also with my freshly manufactured accounting degree to help them with the P&L for the traders on the team. So it was a nice way to look over the shoulder of some successful traders and see what they were doing to generate returns. Now, their algorithm turned out was not very complex. It was just sort of a stair-step moving average, which is essentially a moving average from a higher time frame plotted onto a lower time frame. And they were using that to generate directional signals and a bias on certain stocks. So this was the genesis of my thinking about how is it that you identify an opportunity? What characteristics are inherent in a good opportunity versus a bad opportunity? And also the concept of thinking of my own ways of describing the market that I saw. Because as you get deeper into this process, you'll find that there's a lot of ways to relate the market environment. You could do it by volatility, you could do it by momentum, you could do it by numerous different ways. So that was the genesis of my software. I saw what they were doing, thought, gee, these guys are making money. I see how they're making money. I know the setups that I like to trade. I can replicate these setups in my software, and I can add some additional layers of oversight. So the end goal is that when you are looking at a market, instead of you wondering what comes next on that far right margin of the screen, you have some means of determining what course of action to take. So let me jump into the PowerPoint that I have made. So I'm going to share my screen.
Alrighty. I was just going to actually ask you about that, if whether you had the PowerPoint or the SCMR trends up on the screen, just so some people know that you know what they're looking at. Sometimes I just hear, "Oh, what are those blue candles for?"
Yep. Well, we'll get into that. Oh, may as well add. Going to quit this. That I have a special discount for today and tomorrow only. So if you do decide that you're interested in this software and you go to this link, tiny.cc.scmr, which is just an URL shortener, it will take you to a special discount, which is 46% off the normal price. So I just did that to show my appreciation to the people who are giving me the time and willing to let me do this presentation. So,
and I just wanted to say I did tweet out that link at BTC VIX, so that should be my last tweet if people want to find it that way as well.
Excellent. Well, I appreciate that. All right, so let's jump into this presentation. Is this full screen? Just want to confirm that it is.
No, not yet.
Enter full screen. How about now?
Yes, now it is.
All right, so this is generally going to go over what the software is, explain it briefly. And I don't want this whole thing to be a pitch for the software. You guys get that. It's going to last 15 minutes. The rest of the time, we're going to go into methods of implementation and a little bit of the math behind how to best structure your trades. So ideally, whether you use this software or not, you'll take something away from this lecture positively, as in, how can I, better set up my trades on a risk-reward basis? So one of the issues with the market today is that data is everywhere. So we have market data is ubiquitous. Instead of having to pay to get quotes every hour and then, 70s or whatever, now you have quotes everywhere online all day. But the problem is that with all of this data, filtering the noise becomes more challenging. So the meaningful analysis is in short supply. My product, SC Trends, or SCMR Trends, SpyderCrusher Market Research, takes the guesswork out of the price action and risk management decisions, in as much as that all of the setups and price behaviors are labeled consistently, and they're easy to see because of the color coding. So with all the blogs, Twitter, TradingView, chat, TeamSpeak, there's huge democratization of ideas, and that before, if you wanted someone who was in the know, there was really no way to know what they were thinking unless you knew them personally. But now you have access to, professionals of all stripes via the internet. So there's lots of great information out there, but how do you make the most of that information? And you can see I have a couple of screen grabs, and these are both people who are actually extremely talented at trading. I removed their name from these little grabs just to illustrate NASDAQ percentage of stocks above 50 moving average is probing June lows now. That is a useful data point, but how do we make the most of that? So this is what we're going to get into, is basically these types of descriptive statistics and how we can translate that into an actionable idea. Because in and of itself, it's hard to parse what this statistic means. So now we can see a little bit about how many trading methodologies will fall short. Because we have so much data, how do you filter the data into a better idea in real life? And this is one of the backdrops for why I developed this software, is that 99% of indicators, RSI, stochastics, MACD, they work by smoothing price behavior over some look-back period, and this smoothing destroys the contextual significance of an individual data point because it assumes that they're all equal. So if you have some X period moving average, it just is averaging them. Or if you have an RSI or a stochastics or any of the myriad other indicators that are available, they essentially are smoothing that data, which means that if there's one particular event that is critical, it can often be overshadowed. So one example that I like to give to illustrate that is the height of the US family. If you have a man who is 6 feet tall and a wife who is 5 feet tall and a baby that is 1 foot tall, well, if you average that, that's 4 feet. So just saying the average height of the American family is 4 feet tall, contextually, well, mathematically is correct, right? But contextually is completely wrong because, of course, we know that's absurd. Babies grow, and it's not useful data. The problem is that in the market, those types of relationships are not nearly as clear cut. You really don't have a good litmus test for, is this a 1-year-old baby ready to grow, or is this a 6-foot tall man who is most likely done growing? So a little bit silly of an analogy, but that explains how something can be mathematically correct, as in an average or stochastics or whatever, but relay relatively little data net. So what is one of the issues? Well, if you're a regular trader, you got some idea of what you're doing, you got your risk, you got your breakout, something happens, well, what do you do next? So there's two components to trading. It's one, how do I structure my trade? And then two, how do I plan for the unknown in order to mitigate the risk and basically try and maximize the reward? So we have come to the core problem, which is that traders need a solution to improve their execution of ideas and understanding of risk with ever-changing market conditions. So the question that I pose is, what compels a predictable reaction, and how can you use my software to find that? Well, that is what we are attempting to solve now. So my software will sequence price data, which basically turns all of the complicated market machinations up, down, sideways into an easy-to-read template for understanding. The reason that this works is because once we go a little bit deeper into what the sequencing is, it's consistent, and it's basically, it moves backwards into a mathematical certainty where if this future outcome is going to happen, which is some price movement, then these things have to happen first. Otherwise, it's extremely unlikely for that future outcome to occur. So in planning for the future, you want to look at the present data, and that's how we essentially figure out what trades we're going to make. And to look at the hand on the hot stove analogy, which I like, it's what compels a predictable reaction. It's not just putting your hand on a surface. It's not putting your hand on a stove. It's putting your hand on a burning hot stove that will cause you to recoil in pain quickly, and that is the predictable reaction we are trying to find. So if you break it down, it's a sequence of 1, hand on surface, 2, surface is stove, 3, the stove is burning hot, 4, that's the bet that you recoil in horror. And of course, that would be a pretty high odds bet that's going to happen if you put your hand on a stove. So that is basically what is behind the algorithm. And I think it's important to break that out because you don't want to have some crazy black box where it's like you don't know anything that's happening. Now, the amount of work and research that I spent determining the sequences, that of course was years of effort and thousands of hours. But the basis is that we have current price behavior, we have reverse engineered sequences of known behavior, and we create what is basically a mathematical fingerprint of the expected activity. The different colors that show up on the algorithm will explain to you what the identified behavior is. So this allows for deductive reasoning of future outcomes, since almost all of the future behaviors start with one of the SC price fingerprints, much like the outcome of the hand on the hot stove. So I hope you're beginning to see how this differs from just a normal moving average or normal chart, in that not only are you getting context, but you're getting behavior and basically action all built into one. And the best part is that the software is aesthetically pleasing in as much as there's not hundreds of lines and Fibonacci spirals and etc.
Hey, Danny.
Yeah.
I don't want to go too much in a tangent, but I was listening to what you're saying about kind of those outlier events. I think you make a really strong point that a lot of the other oscillators and TA related stuff is trying to kind of do like a Gaussian distribution of price. But like what your product does is it's looking for those specific events that really are like pinnacle to price action going forward. Is that
yes,
correct?
Yeah, that is great. And you know what? You actually have basically magically read my next note card, which is that all of so I appreciate that comment because that segues perfectly into the next thing, which is that all of these statistics, like the moving average 50 is this or the stochastic is that, are what are called descriptive statistics. They're point estimates. So in the difference between a descriptive and an inferential statistic is that a descriptive statistic is merely a number for simplicity's sake, whereas an inferential statistic will have some kind of probability-based spectrum behind it. So, you know, you got your normal distribution. You say this is 3 standard deviations away, and the t-score and the probability of this, that whatever, like all those statistical metrics that we all know and love. The problem is that the market returns are not normally distributed. They experience excess kurtosis, which is basically fatter tails. There's a skew, so it's not an even normal distribution. And to top it all off, when you try and correct for these errors, you're basically committing the sin of curve fitting, which is taking some finite data set and trying to apply some rule-based logic into how can I make this look prettier. So we're going to get into how to avoid that a little bit, but that is what makes, you know, the whole endeavor challenging, because if you think there aren't scientists and computers that could just simply reverse engineer some XYZ, that's, you know, that's only just the outer crust of it. And that's why we're going to have a huge emphasis on the risk management part, because that's how you're going to take the ideas that my software gives you and maximize them and capitalize to the best of your ability, given the limitations of what is essentially, you know, a fingerprint or some other type of value. Because if I said, look, this particular pattern has a extremely high statistical likelihood of working, it would essentially be curve fit. And what I did rather was, instead of looking for the most curve fit pattern, I looked for the most predictively reliable pattern in terms of providing the correct mathematical structure. So let's get off that, because math is, you know, a little bit going to put everyone to sleep. And let's just say that the basis for what the program is doing is we're trying to avoid the pitfalls of a merely descriptive statistic, and we're trying to avoid curve fitting. So when we look at what is going on with these price fingerprints, we have 16 different behaviors which precede stock movement, which are built into the algorithm. So don't really bother, you know, getting too much into this. This is, of course, for, you know, like if you're staring at a monitor for a PowerPoint. But essentially, if we are in a downtrend, do you short this? Do you long this bounce? Is this a reversal? Is this right here chop, just another leg before a downtrend? Is this an actual low? Do you go long? These are all the types of questions you would ask yourself, right? Because you don't know right here that this is coming, and you don't know at the blue circle that the leg up is coming. So that's why the sequence matters, and how the sequence, the price behaviors that precede stock movement, will help you contextualize the behavior better. So if we go back to an RSI you could say might have 2 price behaviors. It's either overbought on the RSI or it's oversold on the RSI. Or maybe you could throw in there's some sort of divergence. Well, that's you know, I guess better than nothing, but again, it doesn't do a great job contextualizing all of the data. And you know, those strategies have been backtested and backtested till the cows come home, and they really they don't completely work. So given that markets are cyclical and styles are cyclical, in as much that sometimes the market will be experiencing momentum, other times there will be mean reversion, what you want is something with the tools that allows you to handle all those markets. So in the 16 price behaviors, we have mean reversion indicators with pivots and reversals. We have trend indicators, which of course is sort of the red light, green light. And of course, we've got other data points that pop up warning you about changes in market characteristic. So the advantage here is that allows for setup recognition and better execution. Because instead of wondering what is the context, what is the context, what is the context, you're just wondering, well, how do I act best given this context? And just a couple things, food for thought. In 2007, 2008, what was really popular, maybe 2009, was an RSI-2 strategy. So that's a regular RSI, good old-fashioned, set to 2 periods. So it's extremely short term. So you had quick burst up, it gets sold. You had quick stab lower, it gets bought. Well, that strategy performed miraculously on all sorts of backtesting for that period. I mean, really, like, there were a lot of copycat strategies that just popped up out of nowhere with these beautiful equity curves and all that. Well, all those went horribly pear-shaped post-2009 low, and it's been all momentum. And you might say, well, but, you know, quantitative easing and all this jazz. Well, I mean, at the same time, you could make this other counterfactual or other hypothetical about, well, what about high-frequency trading, which really took off in 2007, 2008. That's mostly a liquidity-based strategy. So you were selling into strength, you were buying into weakness. That should foster more mean reversion. And yet, what have we seen? We've seen even less mean reversion in the last couple of years, markets are, basically just exhibiting momentum for the most part. Same thing with the oil boom in 2008, oil bust. So the point is that you want something that's not pegged into mean reversion or pegged into trend. You get a moving average crossover, market is very trendy. Although the moving average crossover is going to be really laggy, yeah, it'll get you in most of the trend. Then you get into chop zone and you're done. So that's essentially what you're trying to work against. Is you want to have different methods, but all built into one, software system if you're using for idea generation or execution. So this goes on to a little bit more detail about the trends in the bar to bar, but we will cover that actually in another part of the lecture during examples. So let's just sum it up. SC Trends will tell you with clarity what the trend is, what the setups are, what the risks are, and which bars to enter or exit. So this effectively solves a lot of the decision-making process that traders, portfolio managers, analysts, whomever might encounter. And I guess I'll just make a quick side note. One of the ways that I find the value proposition to clients depends on what your modus operandi is. If you're a larger firm, then really what you're looking for is less like a specific buy point and more about an action decision area. So you say, look, we need 500,000 shares of this stock. We have to buy it over the next 2 weeks because that's the liquidity of the stock. Well, if you can save 10 cents on your cost basis times 500,000 shares, that's significant savings for your client or the overhead and the costs of your firm. So that would be basically the proposition about why my software would be beneficial. If you're a retail trader, you're not going to be trading that same way. You actually have an edge, a liquidity advantage, in that you can just plow in and out of your whole position without really affecting the market. So in that case, you're going to want much more specific entry-exit rules. And I think it's fortunate that this software works very well for, both methods. So we're going to look at a good chart, bad chart to kind of finish up this presentation, because we have to ask ourselves these critical questions. Is the recognition of price behavior actually better? Can you actually get better entry points? Is the decision-making process actually more clear? So by the end of this presentation, I hope the answer is yes, but I'd like to show you some examples anyways. Bad chart, lack of clarity. Now, this is not pulled from TradingView, but I know some of you are guilty of this. I'm not naming any names, but let's see what this whatever is going on here. Read the actual caption. Chart does not provide any indication about what's next. Yeah, you're telling me, right? You couldn't have possibly made this up to be funnier, as if I did not know that this is providing no indication about anything. Like, what is happening here? So context, clarity, very important for decision-making process. And if you think about what your job is as a risk manager, as a trader, it's not really to, whip out your abacus and make all these crazy geometrical shapes. It's to consistently identify risk-reward opportunities that are in your favor. So one thing that I strongly recommend, depending on your personality, is that you find something that makes sense to you and you stick with it in terms of your risk-reward, personality, I guess, if you want to look at it that way. So you don't go to medical school and become a heart surgeon, pediatrician, endocrinologist, pulmonary internist, whatever. It's like you do one thing, it's very niche. That's your specialty, you have mastered it. Same thing with football, if that's a more relatable analogy. You're not the wide receiver, quarterback, and linebacker. You are really good at one thing, and that's your role. So depending on your personality and your risk tolerance and what your goals are for either highly risky trading, just steady capital appreciation, that should influence how you trade. So no, you should not be scalping on a 5-minute chart if you are more risk adverse and want lower commissions and lower tax obligation, perhaps. Because if you want lower tax obligation, you should go long-term only. You get beneficial tax treatment. So that doesn't mean you don't trade, doesn't mean you don't manage risk. It just means that you are adjusting, you are either the linebacker or the quarterback or the whatever in this analogy. You don't have to do everything. So when we're looking at context and clarity, that also factors into, you don't want to be looking at this thinking something has to happen when really nothing is happening. Here's another chart, which is just no indicator, and here's a stochastic, and then here's trends on in the background. If you just look at this regular chart, you could argue that price has dipped. Look, the stochastics are turning up. maybe this is a positive divergence of some way, shape, or form. Is this a good opportunity? Well, no, because we're adding context and clarity with the trends program saying that there's no reversal here and that price continues to move lower. So essentially, we kept you out of a larger decline, or at least one stop out, right? Because this original chart didn't fully contextualize the trading picture. So, in review, sum the whole thing up. Trend lines, traditional indicators, etc., if they help you, that's fantastic. But they are not the most effective tools at communicating price behavior, risk, or setup optimization. Smooth data, stochastics, whatever, they blur the significance of a particular data point. Indicators where the cause-effect relationship is assumed will lead to incorrect decisions, such as, oh, stochastics is low, price must be low too. And then not knowing which data points matter in context will net-net lead to worse decision-making. So those are essentially the benefits of the software. What the software will prevent you from doing is on this slide, the bad charts review. You don't want to have a bad chart. You want a good chart only. So let us jump to TradingView now.
Yes.
So we can look at some examples firsthand. All right. Now I'm going to take off this little volume indicator. We don't need that. Okay, so here we have a daily chart. So what we're going to do right now is I'm basically just going to show you what some of the signals are, and then we can talk about how to best manage our risk and etc. on the entry and exit. So full screen. Okay, so the color coding is meant to be relatively intuitive. We'll start with the trends. Red is down, green is up. That's simple enough. We have confirmed reversals. These will plot as an O under price. A confirmed reversal essentially means that we are not in an uptrend, but we have enough evidence now that suggests that an uptrend will develop to surmise a tradable low. So these blue bars that you mentioned earlier, what they're saying is, hey, pay attention, we could be near a reversal point. So there's no call to action yet. It's just saying, hey, pay attention. Nothing, 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 downtrend, downtrend, downtrend. Here was a blue bar, although it's very narrow. You can see that it was blue. And what followed was we had confirmation of the blue bar, so we get a signal. And now one thing that's important to realize, and this is really where we're going to get into with the risk management, is that you don't always know what the market will give you. So here we had a reversal that ended up working. Here we had a reversal that ended up working. Here we had a reversal that arguably ended up working. It did, in fact, proceed and move up. But the thing is that, of course, this reversal, or even this reversal, were sexier, let's say, than this reversal, which was very small, or this reversal. So philosophically, you have to ask yourself, is this, as an entry signal, correct? Well, the price did, in fact, continue higher. The reversal made sense. This, as a pivot low, made sense. But you can also see that there is, some leniency in what the market will give you, which is, again, why we manage our risk number one. So we have uptrend, downtrend, confirmed reversal. Pivots, those are the P's. So a pivot basically denotes an area where we expect price to move away from. So the pivots will appear either above the bar or below the bar. I did that in an effort to provide a slight bias for direction. If it's above the bar, the bias is slightly down. If it's below the bar, the bias is slightly up. But the main thing is that it's a breakaway from this area. So I, in the past, have made the mistake of overemphasizing the bias inadvertently, I might add. You should not take the bias as being indicative of the signal. The signal is the pivot, which is saying we expect price to move away. So you can see how when let's just turn this off and we're going back in time and it's like, well, is this trend still down? Okay, is this going up? You have people drawing trend lines all over the place, etc. We're trying to provide a simple and easy method to contextualize the data so you can know how to bet in accordance with the trend. The other thing that's worth noting are the X and the Z. The X is one of the few built-in setups in this software. We're going to go over my favorite one, which is the one that I use all the time, and honestly the one that I think works the best. That's my opinion. But what the X is basically saying is that the reversal is likely to cancel, so to move your stop up. So let's do an example, real brief, about how we would enter a trade. We've got the blue bar, that's our pivot, right? And we've got this confirmed reversal. So this is essentially our risk to our stop. If price goes back under here, we know that this reversal failed and we should be out of the trade. So when we get an X, the very next bar, it's telling us that we can move our stop up, lower some of the risk, and we don't get stopped out, and that trade worked. So, yes, sure.
Can I just ask you, so would you put the stop in that instance at the bottom of the wick of the X bar? Or would you
Yes,
put it
yes.
Yeah?
Always outside the wick or the high or the low or whatever. And, you know, you don't have to put it to the penny because if we're talking about the SPY, which is a $200 stock, 5 to 10 cents is something that I routinely do just because you don't want that, like, 1 penny stop out. If it goes past 10 cents, then that's good enough to be actually stopped out if you catch my drift. So this was our initial stop was down here, and we moved it up slightly, so we had lower risk on this trade. Now let's look at this particular instance. Here's a blue bar, here's an entry for this reversal. So this box represents our risk. Well, now when we get this X bar, what we can do is move our stop up to underneath the X bar low. So just looking at the size of the box, we know this trade was a loser, it stopped us out, we cut our risk in half. And that's important because if you look at all the trades in aggregate, and this is always a law of large numbers type of thing, to the extent that you can reduce your loss, you're automatically going to be doing better because once we get into the risk management, which is the next part of the presentation, that's where you see that you are going to force, I have to hesitate to say profitability because there's no guarantee of anything, right? But you're going to force the limit of your losses. So that will make sense in a moment. I apologize if that's not clear. So again, we have another reversal signal. We have an X, which means it's possible that this signal is going to fail. So we have the same entry, but look what happened to our risk. Cut in half again. So essentially, we had one trade that was a winner. This trade was a loser, but we cut our risk in half. So that's not too bad. This trade, we had initial risk. Our risk was smaller, was a winner. So that's something you're always going to want to be mindful of. If you can move your stop up appropriately and cut your risk, then that will be beneficial to your bottom line. Same thing with this trade here. I mean, let's just assume that you got stopped out of this trade in some way, shape, or form. Maybe not, but hey, you know what? Forget about this. I just wanted to show the X because we're going to go over losers and how to handle those because that's a very real part of trading and obviously important to understand. So how do we take these setups and how do we make money with them? I'll tell you right now that what follows is my favorite setup. This is the one that I like the best. And if you are just trying to figure out where to start with this, this is the one that I would recommend. Most of these bars are, they're telling you about some action that you should be taking, right? So if you look at these green bars right here, at this part of the cursor, it's telling you that price is in an uptrend, but it's not necessarily telling you to take action. So what is the bar to take action on, I think is a good question. I included the reversals and the pivots because that's what some people want to be alerted to. So here's a pivot down, here's reversal up, here's a pivot down, here's reversal up, here's a pivot, reversed up. It's like you can't control the market. So the fact that this pivot down and this reversal up and this pivot down were small comparatively isn't really the problem if the goal is to identify correctly in a mathematical sequence where the pivot should fall. But, okay, that's great, you're saying, how do I take a trade based on this? What is a good trading setup? The one that I like the best is the very first colored bar after some other color. Because this was a very good trend in hindsight. So what precedes a very good trend? Lots and lots of red, lots and lots of green. Well, it's bar number 1. This was the first green bar of the uptrend. This was the first red bar of the downtrend. Then if we go, well, let's leave that. If we go over here, this was the first red bar of the downtrend. So in an ideal world, very first bar is where you want to be. You don't want to short over here if you can avoid it. You want to short over here if you can help it. So what is a very easy, super basic system to capitalize on these moves? When you get the first color, you use that as the signal bar to short on the next bar. So this was a red bar. And we can mark the high and the low of the very first red bar visually with these arrows. So you ask yourself, did the next bar go outside of this low? Why are we looking low? Because this is red. It did. So if we zoom in, we can see this little wick went outside this. Remember, it's the first red color, first bar. It's the signal bar. So we would be short at a cost basis of here. And our stop, you could either use the red signal bar, in which case you actually got stopped out, or what I think is the best and what I'm going to recommend for the purpose of this lecture is the gray bar or the colored bar that precedes it. So this, I'm going to change colors to, let's say, blue. This is our stop out area. This down here we will make, let's say, red. This is our short entry. And this sort of not needed. So here is our short. And then now what are we going to do? We're going to set up our risk reward. And what we're going to do is we're going to shoot for at least 2 to 3 units of risk reward in our target. So right now you can see our risk reward ratio is 1. We'll come down here. Let's just say 2. I mean, since we're talking about the SPY, which is not a very highly volatile market, you can't expect too much. So this was a great trade. We covered down here. Fantastic. Now let's come and look at this bar. First green bar, yes. So what are we going to do? We're going to say this would be our initial stop. This is our entry parameter. This is the first green bar. It's the signal bar. Did the next bar go outside? It did, so we are long right here. Our stop is right here. Let's set up our risk reward. And let's see if we can get 2 out of this one. There we go. Very easy. So now, let's look at this bar. First red bar, right? So we've got our entry criteria. Did the next bar go through our threshold? No. So this is no trade. There was no short trade here. Now let's look at this bar. Now I strongly suspect that this is a bad tick. I don't think that the S&P at one point intraday was up 700% that this suggests. But let's just take it at face value. No entry. We got a big thumbs down. No entry. Is this the first red bar? Yes. So we did get a short entry. Our initial stop goes up here. So even though there was a fairly big retrace, we actually did not get stopped out immediately. Well, now you say, okay, obviously life isn't always this easy. Where do we move our stop to? I say you should move your stop to whatever the next color is. So if we're red, and now we're no longer red, we're yellow, which is, basically shows a breakout, I would move my stop to the edge of this. And I would happily get stopped out on this bar because that's just the more realistic thing to say. It'd be unrealistic to paint some magical picture of you knowing the future that this is, it's like, if this is a new color, your premise is short, this changes the context, right? And this is, so you're seeing firsthand how the software helps you contextualize information better to make better decisions. So this was actually a losing trade, and instead of losing our full stop, we lost about 2/3 of it. But let's go back and look at what we had over here. We had a winning trade, a losing trade. Well, we're making twice the amount that we're risking on a winning trade. So if we just did simple $100 bet, this was risk 100, make 200. Risk 100, make 200. So now we're up 400. Hypothetically, of course, and we've got this trade, another risk 100, and what happened? Well, we got stopped out, looks like, at 80, so we lost $80. So you can see that by keeping our winners bigger than our losers, we are putting ourselves in a position to, when we're right, capitalize on our rightness, and we're wrong, get out relatively unharmed. Now again, here's the first red, right? So let's draw our lines. And, don't want to get too confused with our lines, but this would be our parameters. And yep, we are triggered short, and bam, stopped out completely. So another complete loss. So now we've lost 80, we've lost 100, we're down $180, but we just made $400 over here. We're still net positive. What about this green? It's the first green, right? Well, let's draw our lines. No trade, because we didn't go above the high. This is the signal bar. It's the first green. What about this red? Once again, we are short because the price did go outside. So let's see what we can do. Well, we have a new color. We move our stop down. We get stopped out. So we have a losing trade, we have a losing trade, we have no trade, we have a losing trade, and then here would be another long entry that I'm not going to draw, but let's just assume it's a winner. So even though with this very rudimentary strategy, we've got one winner, no trade, one loser, no trade, one loser, one winner. I think we're exactly 50-50 at this point. But you're making money because the risk-reward ratio is skewed in your favor. So real quick, I'm just going to jump into the 60-minute chart because I have pre-made these just looking at the last couple trades. So here's the same thing. Here's the first red bar, yes?
And now we're on Bitcoin now, right?
Yes, now we're back on Bitcoin. So Bitcoin 60-minute chart, we've got here is the first red bar, right? Our stop goes outside the gray bar. Did the next bar go below? Yes, so we're short. Got a nice risk reward out of that. Over here, here's the first green bar, right? But aha, notice we did not get movement outside the signal bar, so no trade. Here's the next first green bar. We did get a long entry, so now we're long. Another nice trade. Here was a stopped out trade. You can see that our risk reward was saying that we would be long here, selling up here. Didn't happen. So we got winner, winner, loser. Now we come over here to this pretty heinous decline. First red bar, right? So we put our signal area. Look, no short entry. Now you might think, well, gee, that's no fun because price did end up moving lower. But the whole point is that you're trying to prevent trades like this. Because you can see that using this as the signal bar, first green bar, right? Let's look at the high of this bar, 296.80. The high of this bar is 296.36. No entry. So using that little bit stricter of a litmus test instead of just green, I should go long, but saying this is the first green, it's the signal bar, will keep you out of more losing trades. And again, let's go back to why this is the premise. Because if we get a huge trend like this, the first one is the best entry. We're just trying to make our entries a little bit better by using this threshold. But look what happens. The market is usually pretty forgiving in a strong trend. So we get a gray bar. This is the first red bar after a gray, is it not? So this is our signal bar. Does the next bar go below the low? In fact, it does. So this was our trade. And you're probably laughing, ha, ha, ha. Look how little you got out of this trade. But each one of these is a 2.5 times risk-reward ratio. So this is 2.5 times risk-reward, 2.5 times risk-reward, 2.5 times risk-reward. Now, this is, I have to disclaim this, that this is just for opportunities. If we go back farther in time, you'll see that there's great opportunity long, but then there might also be a losing trade or two in between. We already went through how there will be winners and losers. But let's just take these. We have risk 100, make 250. Risk 100, make 250. Lose 100. No trade. No trade. Risk 100, make 250. All it takes is a really small good luck streak like this, and we have such a nice profit cushion that we can easily live through, oh, I got shorted here. I shorted here and I got stopped out. That's a loser. I longed here and I got stopped out. That was a loser. You know, so on and so forth. So I really wanted to get that through because I think if to the person listening to this who says, this looks interesting, how can I use this? This is like you could turn it on tomorrow and say, here's the first colored bar. Does the next one go outside? Yes, and set up your risk-reward ratio. And I always recommend 2 to 3. And you can instantly be having a better A, context, B, entry, and C, trading results because you've made the whole thing into one now. You're managing your risk. You're taking appropriate position size. You are not trying to be a linebacker, a quarterback, and a, you know, whatever. You are being, like, this is a consistent setup where you can evaluate your results. And as you build a bigger data set of results, you can say, you know what I've noticed is trading on the 60-minute chart, I feel like I'm too glued to the monitor. I would rather just go to the daily chart and do the same thing there. Well, it's going to be the same thing. I guess this is, you know, we'll go to a more liquid version of Bitcoin here. I'm not sure what this is supposed to be, but Same thing. So we get a green, next bar, yes, we're long. Oh, that was nice. That was like the $100 up day. Here's a short. We're taking the short. We get stopped out. Here's a short. We're taking the short because it goes outside the signal bar. Most likely you made some money on this one. Here's a gray bar. Here's the first red bar. You're short. Hopefully you made some money on that one. Here's a gray bar. Here's the first red bar. You're short. Most likely made some money on that one. Here's a green bar. We're long. You know, and I'm not going to do every single risk reward, you know, little map, and I recommend using this tool. You should marry this tool. This tool should be extremely on everything that you do because this will help you stay consistent and going, you know, I have 60% accuracy when I shoot for a smaller risk reward, but I want, you know, larger wins so I could go 3-to-1 instead of 2-to-1, and that will help, you know, that will give you more profit cushion. So let's now go into the very quick math behind this, so you don't think that I'm just making this up, because I assure you that I am not. Let me exit the full screen. Exit full screen, and now we are in my slideshow number 2. Oh, let me just really quickly say that this tiny.cc/SCMR, that is the 46% off coupon. So if you have just joined in and you caught something you liked and you think it might be worth a shot, then, you know, I appreciate your business, and I think that most of my customers will tell you that I have excellent customer service, and I strongly strive to maintain that reputation.
And just to clarify, they get the entire suite out of that?
Yes. So we barely even glossed over. We just looked at the trends. There's support resistance levels, there's momentum measurements, and there's a bar-to-bar counter. But I want to, you know, I could spend 5 hours talking about different strategies and different methods. I just wanted to keep it simple and show a very quick way where the audience could just go and implement the trend trades that I outlined without a lot of complexity. Because what I found in doing these webinars, because I've done a couple of them, none as illustrious as this one, but just with individual clients, is if we go to, let's go to a one-day chart. Now I want to show you something, just in case you guys don't know about this. I've made bookmarks for all my charts. So rather than going down here and loading, you can see I've organized them. Econ, 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 fund, macro, macro, correlation, SCMR. This is a nice way to organize in TradingView because otherwise you get all your charts all confused. But rather than having to click 15-minute, 240-minute, 5-minute, 60-minute, I just bookmarked them. So now my life is a lot simpler. I just type in 15M. That's my top bookmark. Now we'll go to the 15-minute chart. So here was the S&P today. We can see that we had a confirmed reversal. The confirmed reversal canceled. Price did subsequently move lower. This was a breakout bar into the FOMC meeting. Great move higher. What I want to show you is these dots, which are support, resistance, and target levels. Again, I don't want to get too carried away on that because, you know, if you end up using the software, I always reach out to every new client and we can have an in-depth tutorial on their use. But they're exactly what they sound like. It's support, resistance. You can adjust the length of the support resistance. So if we come in here, we can go, you know, I want to see a 3-month, which is basically a quarterly support resistance. And that will, I guess maybe I picked the wrong one. Well, anyways, I think you guys get the idea. So if we want to see 21 days, we can do that. If we want to see 5 days, there's 5-day support resistance. Here's that, you know, the quarterly support resistance. You're probably saying, why are there only supports? Well, because the market has been in a long-term uptrend. You don't look for resistance in an uptrend because otherwise you're going to be selling everywhere. And on the long-term time frame, which is quarterly, certainly, this makes sense. If we change it to a 1-month time frame, then what we're going to see is we've got brief periods where we were in a monthly downtrend, but for the most part, again, it's in a, you know, long-term uptrend. So anyways, you can really make it customizable to your own, you know, needs. If we go to the 240, and this is on Bitcoin futures. Oh, and I provide all of these templates, so you don't have to worry about setting this up. You can if you would like, but all this will just come to you when you subscribe. You can see, you know, here's a pivot down. Here was a reversal up. Here was a pivot down. Here was a reversal up. So that was pretty timely. Came down. We had a breakdown with no follow through. Here was a pivot into a huge bar up. Pivot that broke up. One red bar. Now remember, if we were doing our trading strategy, what would we do? We would be using this as the signal bar, no short. We'd come over here. We'd say this is the first green bar. That's our signal bar. No long. First green bar, signal bar, no long, first green bar, signal bar, aha, now we're getting long. So you can see how using this as the signal bar is going to keep you in the better trades, but keep you out of this green bar went nowhere, this green bar went nowhere, this red bar went nowhere. Pivot, price moved down, confirm reversal, price moved up, first red bar. Now you're probably wondering, were we in this short trade? Well, if we're using that signal bar, yes. So this is how you can bring together a whole trading system without a lot of clutter, without a lot of lines, and you already know what you're doing. You're saying, I'm shorting here for a reason. This is the first bar down. In a downtrend, we have many red bars. This is the most appropriate time to enter, and same thing on the upside. So this is what you're going to get. If you hit slash on the keyboard, backslash I should say, and you come to the analysis suite, you get these 4 tools, and you can edit your subscription and all that. So that is looking good. This, I hope that you guys are still with me here, because I know it's kind of hard to sit and just listen for more than an hour, but this is really an important part of the whole thing, which is our risk management. So let's do this real quick, and then we can do some sort of Q&A or something like that.
I just wanted to step in here because I do think that is actually a part that's really lacking in the the Bitcoin trading space. I like to say that we're all kind of degenerate gamblers, especially on the futures market. So I'm glad you bring that up.
If I can poke fun, I would say that the Bitcoin community is especially adept at making insanely risky trading decisions, which of course I mean nothing negative by, but really, so I completely forgot about this. I hope that this is okay to interject in here. I really should have said this at the beginning, and if you edit this, please actually add this at the beginning. But it's really important for me to make very clear that A, this is not a solicitation to buy or sell securities. B, I don't know you and I don't know your risk tolerance. So when I suggest a strategy, such as the one that I just suggested with the signal bars and the entry and exit, that is merely an idea of an illustration of how a person, not you, could use the software. I can't offer you individual customized advice because it is literally illegal for me to do so. There's rules called Know Your Client. I have, I'm covered under FINRA, which means that, they're serious about that, and so am I, to be honest. So I can't say what is better or worse risk for you. I don't know your personal circumstances. I don't know your tax situation. I don't know your family obligations. I don't know anything about you. So, not a solicitation. Trading is extremely risky. All of these strategies may not work for you, and they may have adverse tax or whatever consequences. So, glad we got that out of the way. Which, of course, isn't to say that I don't believe that there's merit to the ideas that I presented. Don't get confused. But I have to disclaim that, the past is not necessarily indicative of the future, yada, 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 all that stuff. So that is essentially what this is saying. This reminded me that this was here. And the other thing that I'll point out is that the software, if you decide to use it, is proprietary software, which means you can't sell it, share it, release it, make a trading service around it, because otherwise you'll be in trouble with me now. So by, viewing this, you have to agree to have understood that, both disclaimers anyways. So, risk management, expectancy, Kelly betting, complex and disgusting looking math formulas. What does it all mean? Well, fortunately, fellows smarter than I have determined what the most optimal betting strategy is. And the guy who really made this famous, his name is Kelly. And the Kelly betting strategy is essentially the one that maximizes the geometric mean of returns. That's a very fancy way of saying compound annual growth rate. Now, what kills compound annual growth rate, or maybe not annual, but compound any period growth rate, is volatility. Volatility of returns is what kills the growth rate. So you don't want to see this. You want to see this. to the extent that it is possible. So how can you have your equity look like this and not like this to the extent that it's possible? Well, you use Kelly betting. So what did Kelly discover in his extremely complex mathematical proofs that you'll be happy that I'm skipping? Basically, this is what I wanted to go back to that other example with all this on it. Essentially, what Kelly found is that if you look at the size of your winners relative to the size of your losers and the odds of any of them happening, you can come up with what is the optimum bet size. So if we look at this particular trade, our risk-reward ratio is 2.5. So what that essentially means is that we risk 100, we get 250 back. Now, what are the odds of us being right on this? I don't know. I mean, let's kind of maybe just play around and see. So if when we're right, we make $250, and we are right, let's call it 32% of the time. So I hope you see that's a pretty fair assessment because you're unlikely to be so wrong. But let's just say that you are, because I think it's better to be conservative. So we only win 1 out of 3. And we're going to compare that to our losers, which is we know that when we lose 100. And obviously, if we're only right 32% of the time, we must be wrong 68% of the time. 68% wrong. So let's clean this up so Google can do the math for us. And this is essentially the expectancy formula. Now, I notice there's a couple important variables. One, how often are we actually right or wrong? Well, I'm going to show you why that doesn't matter so much. But really, you know, that's critical. And how much are we right when we're wrong? So you can see that this has a positive expectancy. The expectancy is 148. Oh, no, I did this backwards. Sorry, I forgot the minus sign. My mistake. The expectancy is 12. So what this is showing is that if every time we trade, we force ourselves to take 2.5 risk reward, come hell or high water, you either get this gain or you get stopped out. That is it. Those are your only 2 options. We can be 68% wrong and still actually walk away with a positive expectancy, which means that when we take bet after bet after bet, we will be making money. So I highly doubt anyone's going to walk into TradingView or Whale Club or any of these other trading forums and say, guys, I've got fantastic news. I was 68% wrong today in all of my bets. But the fact of the matter is that this has a positive expectancy. That means this bet is profitable. That means that if, in theory, you could take 1,000 of these bets a year, oh, forgot a parentheses, that you would actually be making good money because each individual bet is worth $12. You take 1,000 of them, you've made $12,000 trading. Now, of course, that is entirely dependent on A, are you actually this inaccurate? B, can you stick to this average expectancy? C, can you find 1,000 opportunities that fit these statistics? So what's going to happen is the statistics will change. You'll be in a better market environment, and you'll get 60, 70% accuracy. Here's a winner, here's a winner, here's a loser, here's a winner. Right now we're 75% accurate. You're killing the game. Now maybe you come over here, and it's like stop out, stop out, stop out, stop out, winner, and now you're only 25% accurate. It's the law of large numbers that's going to give you that blend of somewhere in between. But what you're trying to do is you're trying to sleep at night. That's what risk management is about. So if you can't sleep at night with the assurance that even if you are almost 70% wrong, which I mean, like my 5-year-old niece can guess as good as, 70% wrong is like pretty spectacularly wrong, right? You're still not even completely losing it, right? You're not making good money, $12 on $100 bet average, but you're not losing, and that is the main thing. So that is what this math says. Now, what Kelly did is he wanted to maximize the geometric mean of returns, which means that instead of this being your positive expectancy, you actually worked this whole thing into your bet size. Now, I'm not going to teach you what that is because what researchers have ultimately discovered, which is the next part of my slides, is that Kelly bet size is too volatile. So if you come up with F, which is your bet size, based on these statistics as I outlined, then you have too much volatility, can't recommend that. So now we get to our Kelly fraction table. Don't be scared, don't be shy. This is actually very easy to understand. Each one of these Ks represent a Kelly size. 1 Kelly is our full bet size. half a Kelly is half a bet size. You can see that the min, which is what we're going to pay attention to, was out of 2,000 trials from this white paper. What was the lowest possible account value, starting with 1,000? So you can see that the absolute lowest account value, starting with $1,000 on the 1/4 and 1/8 Kelly bet size, was $500, let's call it. So I want you to think about what this means. This means that out of 2,000 randomized trials, where some were really bad, really bad, I mean, we're talking about much worse accuracy than even is statistically likely, you still only lost half your money. And I say only because there's lots of people that are losing all their money, like all the time. So what are the numbers that, make this so we're talking about $587 out of 1,000 in this experiment, or $513 out of 1,000 in this experiment. Notice how as we increase our Kelly size, the odds of ruin go up, and that's what we're trying to prevent. So using a half Kelly means that there were 111 cases out of 2,000. No, there was sorry, that's down here. There was many instances of people losing 90% of their money. That's what we want to avoid. So this column and this column, this is where we're going to pay attention because we want to keep our risk low. And notice what the maximum was. We still turned 1,000 into 6,000 and 1,000 into 27,000 on the upside. So if you were to say 2,000 randomized trials, each account has $1,000, computer simulation based only on Kelly bet sizing, not strategy, because strategy is curve fitting, remember that. You can say that the lowest we did was we lost 50, the best we did is we made 27 times our money. So that is why I recommend 25% Kelly bet sizing, which I'll show you how to calculate. So hope you can stick around for that. These numbers right here show the actual number of times that you exceeded a certain threshold in dollar amounts. So this is a little bit confusing of a chart. I don't really like how they did these numbers, but 5 times 10 squared equals 500. Can we agree that that's 500? So what they're saying is that 2,000 out of 2,000 trials did not lose half their money, and that's this number right here. If we look at 10 to the third, then that's saying the amount that at least broke even, because 1,000 to 1,000, that's 10 to the third. So 1,957 out of 2,000 trials broke even using 0.25 Kelly bet sizing. Think about how phenomenal that is to a struggling trader, to know that if you have the proper Kelly bet size and you are consistent, and it's like dieting or quitting smoking or going to the gym or anything. You can say it, you have to do it. That in the significant majority of trials, you broke even. And sure, trading for a whole year full-time to break even is not something that's great, but you have to consider the alternative, which is that most people are actively losing their money practically, for the sport of it, it seems like sometimes. Now, what's the trade-off? There is a very definite trade-off between risk and reward, which is also what this is showing you, because if we do 10 to the fourth, which is 10 times 10 times 10 times 10, that's 10,000. Well, only 100 out of the 2,000 simulations broke 10,000. So if you followed this to the letter, you'd have only a 5% chance of doing 10 times your money, which means that you're never going to be one of those guys saying, oh my God, I made 8,000% today. But that is great with me because you want to find some happy medium between, where was our mess, our this, because this is what will lead you to the road of ruin, ultimately. Whereas this is you sleep at night, and you can get more and more aggressive as you get more and more experience, but you have a framework for not blowing it, as it were. So let's go to the next page on this. This shows basically the wealth path. You can see that the higher the Kelly, the more wealth we made, but at the same time, the higher the Kelly, the more we basically went to zero. So I would argue that these two, the blue and the orange, while the lowest return, offer the lowest risk, and that's in fact what researchers have found, is that the lower Kelly bet sizing is the best marriage between risk and reward, such that you can avoid financial ruin and also basically gain from these types of trades. So,
Spider, would you say that we just kind of qualify that as risk-adjusted return? Is that what sums it up essentially?
No, because risk-adjusted return, I would say, factors in two other details that we're not getting into, which is the risk-free rate, and then that would factor into the cost of capital. So you have to look, like, what if I just never traded again and I put my money into a government treasury? That's essentially what you're foregoing as an opportunity cost by trading, not to mention the cost of your time. So that's a little bit harder to calculate, but just looking strictly at, just the raw data of bet sizing, we're trying to maximize our upside while minimizing our downside. And number one is minimizing the downside. So when we look at how the Kelly fits into our risk and execution over here, we've got a whole nother line of research, which is, well, okay, we can do multiple risk reward. That's easy enough, but based on what exactly? Well, it turns out that there's 3 layers of curve fitting and data massaging, I guess. 3 types, and don't confuse these with type 1, type 2 error from statistics. But there's 3 types of biased estimator errors. Keep in mind that all this data, these are all descriptive statistics. They're all a point estimates somewhere on a spectrum. We don't know if the spectrum looks like this, or if the spectrum, and this is out here, or we don't know if it's like this with a huge fat tail, and So anyways, that's what we're trying to put a handle on. We have biased inputs, which is I have this moving average, this moving average, this moving average. I got all these EMAs, or I got this cross, or this stochastic, or whatever, and I'm going to fiddle with the entry, the number, not the entry, the numbers. So I'm going to do a moving average 2150. Okay, that's okay. I'm going to do moving average 1949. Okay, that's okay. I'm going to do moving average 1847, or whatever I'm saying, right? That is the most biased and the worst estimator according to all the research that they've done. Biased input. So you're just playing around with the stochastic value that gives you the best result, or whatever. The next, the most biased. The one that's slightly better but still very biased is a biased entry, which is you're doing the same thing, but you're only fiddling with the entry. So at least you have the exit based on risk reward, as we've talked about. You got your 2 to 1 and everything's good, but you're still messing around with the entry, trying to create some optimized framework for how to enter. The least biased, and they're all a little biased, but the least biased is where you have the consistent entry and the biased exit. So the biased exit is easy. That's just saying, should we be doing a 2 times risk reward ratio? Should we be doing a 2.75 times risk reward ratio? Should we be doing a 3 times risk reward ratio? And I'm hoping that I put this up. Oh, dang, I guess I must have left this slide out. Sorry about that. But what I was going to show is that given the trade-off between risk and reward, the more rewards you search for, this case 3 times versus 2 times, the less likely you are of achieving that reward. So if we come back to this math example over here, what if we have 5 times risk reward? That's 500 per 100. Well, let's say that we're only right 12% of the time. So as a corollary, of course, we're wrong 88% of the time. We can see we've lost money. So the only way 5 times risk reward makes sense is if we can get to it's kind of just a little bit of trial and error, right? So we have to be, let's call it 18% accurate with 5 times risk reward to make money. Now, if we come down to 225 times, that's 2.25. Now, let's say that we are, making these numbers up, but for illustrative purposes, let's just say 45%. We're actually doing pretty good there. We could be much more inaccurate, it turns out. So this is how you can sort of reverse engineer how wrong you can afford to be. So when we look at 2.5 times versus 5 times, let's see how that plays out. Looks like I accidentally deleted all of my other pretty charts, but we'll just do one. Drawing tools, remove. So let's just take, I don't know, I want to find just one winner and one loser, because this is for illustrative purposes. We'll do this one. Long position, long here. So if this is our situation, we've got 1.5 times risk reward. Well, hypothetically, we could have got up to, it looks like 3 times, and we would have been wicked out. Remember, this is very stylized, very cherry picked, just to illustrate the point. So if we had done 2.25 times risk reward ratio, look at what it says the target is, 1.92% away from our entry. You have to ask yourself, how often does Bitcoin move 1.92%? I would say that happens practically all the time. So if our directional bias is correct, based on our entry signal, that it's very achievable to get this return. So you can say that with a 2.25 times risk-reward ratio, that it's realistic to assume that we will be 40% accurate, 43% accurate, 45% accurate, whatever the case may be. Now let's say we were looking for 10 times risk-reward ratio. We will settle for nothing less, than the best, 10 times. Well, now we're saying 10 times risk-reward ratio, that's basically 9% movement. Now you'll say, well, how often does Bitcoin move 9% in a given time? Well, surely it does, but obviously, you picking the exact bar that precedes a 9% move, even in a volatile instrument like Bitcoin, is pretty rare. So you would have to say that the odds of you being right are extremely low. If we're going for 10, you might only be right 7% of the time in jumping in front of a moves like that. Now the good news is, going back to my software being helpful, is that should you get a large move like that, you most likely will be validated. Like, this was a long entry, maybe this was that 10 times gainer. But then of course you had this not 10 times, this not 10 times, this not 10 times, this not 10 times. So that's going to be the trade-off between how much you're looking to get versus how right you are. So I think the happy medium is if you pick between 2 and 3, you will end up being right between 40 and 60% of the time, somewhere in that spectrum, which is enough to make money using this framework, and also not feeling like, geez, I am just wrong all of the time. Because if you're shooting for 10 to 1 risk reward, you're going to be wrong pretty frequently. So when we look at remember, what is Kelly trying to do? Kelly is trying to maximize our return. This is a mathematical theorem that has been proven as basically the maximum way to maximize the return. And of course, please email me for the link to this full paper. I did source it down here. You can just search for how does Fortune's Kelly's formula capital growth model perform, and if you are trying to put yourself to sleep, you can read it. So how do we put this all together? I think there's one part that I missed. When we are doing our position sizing, this, remember, was our $100 for all of these examples, and then this was our $225 or our $250 or our $400. How does this $100 come about? Is $100 a magic number? No. You take your entire account, which is 100% of your money, and you multiply that by some fraction that we risk. And that is basically your Kelly bet size. So the rule of thumb is that one Kelly bet size could be 10% of your money, which means if you're wrong, you are now down. We went from $100 total to 90, or 100,000 to 90,000. I personally recommend 33 basis points bet size, which is 1/3 of 1%. So if you had $100,000 and you risked 1%, that means every single bet is $1,000. Well, I'm saying you should bet 1/3 of that, which of course would be $300 on a $100,000 account. So now when we come and say, okay, well, let's take this real-life trade idea of, here's our first red bar. Remember, this is our signal, no entry, gray bar. Okay, first red bar, here's our signal. So do we have an entry? Yes, we do. When we look for a short right here, I think this is the short, and we set everything up such as this, and we do our 2.5 and all that jazz, and you could see, look, we could have had such a huge risk reward, but you're not a fortune teller. You're not being paid to predict the future. Prediction is a fool's errand. You're being paid to take appropriate risk reward setups, like a consistent robot. What is it saying? It's saying our stop is 1.42 away. Can you guys see that? So how do we reverse engineer that? We say, well, We have $333 total at risk. We have 1.42 to our stop. So that means we should short 235 Bitcoin. How did we get to 235? Because we're backing into the number that our loss will equal that 33 basis points. So maybe that's too much thirds. Let's just do a simple $10,000 account. We'll do it on this. I have $10,000. I am risking 1/3 of 1%. 1% of $10,000, of course, is 100, so a third would mean $33. 33.3. So this is our bet. If we're wrong, we've lost 33 bucks. That's hardly going to cause you to lose any sleep on a $10,000 account, but that satisfies the optimal bet sizing that we saw up here. So
Can I ask a quick question here?
Let me just say this one thing and then shoot. So this $33 is the same thing. What's our distance to stop? $1.42. So we go to 33.3 divided by 1.42, and I'm guessing that would just be, right, 23 Bitcoins. So you'd be shorting 23 Bitcoins. Now you might say to yourself, well, 23 Bitcoins times $287, what is that, $7,000? And didn't we say that our account was 10,000 in size? We're putting 70% of our money into one trade? No, we're risking a fraction of a percent because of our stop discipline and our risk management. And this is like the actual implementation of the Kelly betting. So I'll get to your question real fast. We're basically concluding at this point. So we've gone over why my software is better than the normal indicator, because context and situational awareness and making you aware of the opportunities. We've gone over a very simple method of how to trade with the software. Use the first red bar as the signal bar, use the first green bar as the signal bar. What's the premise? The premise is that we've reverse engineered the mathematical sequence of up and down. And if you get in on bar number 1, that's the best time if you're expecting up. And if we get in on bar number 1, that's the best time if you're expecting down. We've covered the most important thing of all, which is how do I bet, in the real world terms, such that I limit my downside volatility while still capturing the upside. Well, here we have a table that shows that out of 2,000 accounts, 1,957 of them broke even with 1/4 Kelly size because you are using the right risk reward. Well, is there any validity to this? Yes, there is validity, because we know that the worst type of system is I'm going to change the periods on the stochastics or the moving average, and we know that the best type of system is we are going to just adjust our risk reward from 2 times, 3 times, 4 times, 5 times. Because this is, of course, bias estimator, but not nearly as much as the other ones. We've also shown how using our Kelly system, we could be 70% wrong with the right risk reward and still not actually lose money, which puts us in a better spot because net, we might not be 70% wrong with the various trading that we've, methods that we're using. So that basically is the entire gist of it. I know we went through a lot of that stuff kind of quickly, and I am ready to take your question now, and then I'll do my thank yous and last hurrahs. But I think that's pretty much the complete package. We've got a framework, we've got a basis for action, we've got implementation. So please shoot with your question. Or any others.
Go ahead, Gavin.
I was just going to ask, I know you were on dollar forward. I wanted to see how your trading style or analysis, since it's leverage, say 10x, 20x, how that factors into, if you were playing that market, which is a little bit different than some of the other markets you've looked at. So we're talking
everything is the same. So first of all, you'll notice that in this particular bet size, we're actually not using any leverage because our $10,000 account, $33 of risk. This is our risk size, but we're using 7,000% of capital, 7,000%, $7,000 of our 10. So you actually would only be using 70% of your money on this one bet. Now, if you look at stocks, which is what I trade, what I do is oops, did not want that. I wanted this. I like to trade what I have colloquially called the up, flat, up. It's a very simple setup. So here is a stock, it's going up, I wait for it to go flat, I get long when it goes up again. This is slightly different than the method that I taught about finding the entry with the trend, but you can see that, here's our signal bar, right, short, here's our signal bar long, same type of difference. But what I think if I can answer your question the way I think you're asking it, is that what happens if you have this position on, and here's our 3 times risk reward or whatever, so we're selling up here. But I also find, and this is actually what happened. Let's go to a triple chart and make sure that these are all right. So what happens when you have this too on the middle chart? Oh, you notice my box was already drawn because this was a trade that I took, 2.7 times risk reward, but it occurred basically at the same time as this trade. So this trade was in the middle of February. This trade was at the end of February. What happens then? Well, if this used up 50% of my capital and this used up 80% of my capital, then yes, I would be levered 30% because I'd be using 130% of my capital. But the actual value at risk would still be that original 33 basis points, which on a $10,000 account would mean I get stopped out here, I lose 33 bucks. Stopped out here, I lose 33 bucks, so I've lost $66, which is less than 1%, even though I was 130% leveraged. So when you have multiple positions, absolutely that type of thing can happen. But on just something like Bitcoin, I would say it's pretty unlikely that the structure of the trade would be such that you would actually be using more than all of your capital.
I'm just saying that on the dollar forward, you have to trade either 10x or 20x.
I did not know that specifically about dollar forward. So then, if that would be the case, then you either would not trade on the dollar forward, or you would set up the same trade on a different exchange. To people that are using TradingView, and especially to those that are Bitcoin traders, I, at this point, pretty much only recommend using this 1 week forward as the signal for whatever. Because I've looked at Finex, Stamp, the other exchanges. This, without a doubt, gives the cleanest signals based on my, observation. So if you're getting a signal on this, but you can't afford to do 10x because that would blow your risk out, then just go and execute it on Finex and then use this as the entry, exit, stop criteria. I guess that's the best you could do.
Yeah, that was really good. I was wondering kind of why you were charting that, and so basically that's good to know that you think that's the best indicator of movements.
Yeah,
Yes.
that is the levered future right there that you're looking at, 10, 20x.
All right. Well, this
Which
is
is
the one.
interesting.
This is the one that I would trade off.
Yeah,
well,
that's
that's something I didn't know, so that's definitely good to know. So as far as some of the other trades that you could take, look, we've been talking for an hour and a half, and I covered a lot of ground. I gave you my entire why my software is superior because it is pitch, right? I'm just kidding. Well, but I'm being tongue-in-cheek, but I think that. I mean, I use this for my trading. I sell this research to hedge funds and mutual funds, other people who are professionals in the business, and I'm now bringing it to everyone else. So we've got the risk management side, we've got the trend side. We sort of, maybe you don't know very much about trading. We went into how to, structure your orders. So I did think we covered a lot of ground. Like I said, I don't want to pull up anyone's private thing, so I'm not going to. But every person that does end up signing up, which again you could do with this link for a huge discount, I send them all these chart templates. So whether it's like the 15 min or the 240 or whatever, you can just jump right in and get right off moving. So I guess where I was going with that is that there's so much that we could explore. Like, well, how would you best trade a pivot? How would you best trade a reversal? When should you use these support resistance lines? And all that. We didn't even really get into the full spectrum of what we could do, but we've been talking for an hour, so I figure that's good enough time to get a taste. And so.
Yeah. Let's bring Sonny in. I know he's kind of a shy guy, but I know Sonny was typing some things on the Google Doc. Sonny, do you have something to say?
Yeah. I mean, I remember we had a chat before about what indicators you would combine with SpyderCrusher signals in order to sort of create. I don't know. I mean, I don't know how to put it, but I think you mentioned that Ichimoku clouds are quite good.
I did not. I really have. Well, okay. I remember that conversation, and what I think is that, in my opinion, everything that you need to accurately gauge what is happening is here in the software, and that's it. Because you have trends, you have mean reversion, and you have support resistance, and no matter what your discipline or your belief system is, that pretty much covers it. But that's sort of like my worldview. So it's almost a little bit like a political worldview, you know? Like, you and I can agree 2/3 on one issue and not at all on another issue politically, right? So what I mean by that is that if there is something in Ichimoku that helps you frame price better, or perhaps is a good way to get price action to do something that you think it should be doing, then by all means do it. To me, this does not add, and I mean, I really, you know, I feel like part of the value is that you don't have this on there, right? But if you can get a better signal from that, then absolutely I encourage you to do it. I don't use any other indicators except for this, because why would I need to when they're mostly redundant? Because we went over the whole lack of context thing. But I have absolutely no problem in spirit if you say, well, here's a moving average, let's 9, okay, let's change this to 50, you know, whatever, and saying, look, I'm only going to take long trades above the 50, so I don't need your rule about the red first bar. I'm just not even going to bother. Or maybe you say, you know what, I don't like this pivot, it's too far away from the moving average or something, but I like this green. Whatever it is, I encourage you to explore and augment your thinking on it, you know? It's just that I pretty much designed this to solve what I saw as the problems in most of those other indicators. And certainly there are maybe things that you know, I don't know about, although I did, you know, really kind of do my detective work on the issue. But Ichimoku, look, if you like that, then I would keep using it, and hopefully this can show you something on top of that that's useful, I guess would be what I would say.
I mean, the only reason I mention it is because a lot of the guys here that we sort of trade alongside on a day-to-day basis are not sort of noobs and stuff like that. They come with some sort of indicator baggage in the sense that they have their favorite go-to indicators and that kind of thing. A lot of the guys use Ichimoku Cloud. I've noticed. I mean, I don't personally use that myself. I use a bunch of other indicators, but not Ichimoku. And I just thought, you know, maybe this, you know, giving them an idea as to how we could integrate these two things together. But as you say, it is a complete package, and there isn't actually a requirement to do that.
So what I would say is, look, if you have a idea of something on an Ichimoku indicator that is showing you something, and this can improve that, then that's a good combination. You know, because maybe the Ichimoku says this is an uptrend or this is a resistance area. Well, you can overlap that with a dynamic level or with a pivot or with a red to sort of affect that decision in a more timely manner. The one thing that, this is a little bit off topic, but I always love doing this. Now, if you ever need something to talk about at a cocktail party and you're looking to impress while simultaneously turning off every woman in the room, you show them the stochastic indicator trick, which is why stochastics are such a silly indicator. So we're going to put stochastics on this chart. We're going to make sure that it's set up normal, 1431. What stochastics tell you mathematically, what this line means, is percent in range. So when we have a stochastic 14 period, that's saying out of the last 14 bars, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 14, somewhere over here, we're going to draw a box that covers the last 14 bars. And now we're going to say, where is price on a percentage basis of this entire box? I would say, just guessing, this is at least in the 85th percentile, right? So 85% of the box is above, 15% of the box is below. Guess what the stochastic is going to be? 14.8%. So when we do this game, sight and scene, BTC VIX, you shout out to me any stock, any symbol, any time frame.
Alibaba, 2 hours.
All right, so I'm going to turn off the aftermarket just to make this a little bit easier. No extended sessions. Oh, well, here's that broke it. There's broke TradingView. Okay. Wow, how about 60 minutes? Let's just, oh God, come on. Okay, so this huge candle is going to throw everything off for simplicity purposes, but we can see that in the last 14 periods that this is approximately our maximum high, maximum low box. Current price is, let's just say, right in the middle, so I'm going to guess that the stochastic is 50. And it is 49. That was pretty close. Because remember, this orange one is the smoothing. The actual stochastic is 50. So that was a pretty good guess. Do you have any other requests for time period, time frame?
Netflix, 4 hours.
This is a fun game. This is how you win. This is how you win brownie points with your friends when you're looking to impress. Well, let's look the last 14 periods. Doesn't matter where we start it. This is like the 80th percentile. So the stochastic should be like 20. So how am I doing this? How am I guessing? The stochastic is 22. Another cookie for me. How I'm doing this is that I know what the math formula is, and I know that it's pointless, because if I were to call you guys and say, oh, quick, Bitcoin is in the lower 18th percentile of its 14-period trading range, like, so what? What does that mean? What action do we take? Whereas the other guy is like, oh, look, the stochastics are curling up and we've got a bullish divergence. It's like, no, it's just a box of a percentile. That's it. So I'm being a little bit unfair. And you know what? If you like stochastics, I have no problem with that. But when you say, like, how should I use Ichimoku, so many of those indicators, and perhaps not Ichimoku, I'm just going to talk about moving averages, stochastics, RSI, that's like the premise on which they were built. And RSI is actually very structurally similar to the stochastics. So if I have done nothing else in this lecture besides dissuade you from using stochastics, I will consider that a job well done, because as you can see right here at this particular bar, quite clearly we're at the upper 95th percentile of the 14-bar range on stochastics. So what does that mean? You should sell? I think that's a silly takeaway. Maybe this isn't a good buy because we've already had so many green bars, but what about the next green bar that gives you a valid entry? Like this one? Oh, no entry. So you know what? I guess that's that, or whatever the case may be. So remember, we're talking about context here. Context leading to better decisions and a framework for action. This is emblematic of why it's better than a stochastics, because a stochastics, it doesn't give you any context, and the context that it does give you, as we saw, is kind of silly, because no matter what you pick, you know, this Humana, obviously without even looking, we know this is going to be a 95 stochastic. So how is it useful to have this on our chart, 95.6? That is usually not quite this good at this game. So I hope you can see, like, you can play this if you want and prove to yourself that your eyeballs are better than the stochastics indicator, or you could keep wasting 2/3 of your screen real estate putting this up. The choice is yours. So there's a little bit of a tangent, but I think that kind of also covers why I feel that this software offers a much higher value than just throwing on some indicators that, like I said, are smoothing data and destroying the contextual significance of why some of these bars matter more or others, or just what's happening.
Oh, go ahead, Sonny. Go ahead.
So I was just going to follow up and say, what do you think of volume indicators, like on balance, volume, check, and money flow, that kind of stuff?
I'm not too big on those either, because I'm primarily a price action guy. Basically, when you look at like what are I'm trying to think of the right terms so I don't later go, oh, this is what I was thinking of. But in any sort of correlation of like results versus like the independent indicator versus the dependent indicator, what that means is that one is the leader and one is the follower. Like one influences the other, but not the way around. So volume is not necessarily an influencer, but price is absolutely an influencer, because our counts are denominated in price, not volumes. So if price goes up, that is going to change someone's stop. That is going to trigger a high-frequency trader's, algorithm. That is going to show up on a momentum trader's scan. That is going to show up on the order book as some XYZ movement. People are raising their bids and asks or whatever. So that, to me, is the independent variable of the set. Volume is dependent in that sometimes, I don't know why I started typing that, sometimes you have a very low volume and other times you have very high volume, but that doesn't preclude price from moving somewhere. So the other problem is that what if you get a candle like this? Draw my candlestick, and it's something like that, How would you interpret this, Japanese candlestick theory and all that jazz? Well, you'd say, okay, price came down a lot, and then people bought it back up, and well, what if 80% of the trading volume occurred right here? And what if this was a bullish candle, like it opened, down here, it was like an up day, right? But this is where 80% of the volume took place. On a daily chart, all you would see is a bullish candle with a ton of volume and go, oh, gee, there must have been a lot of buying that day. But you're making so many assumptions there that are like, completely wrong in this hypothetical. You see what I'm saying? So it's like you got this big volume, you got this bullish up day, but what you don't realize is that the actual reality is that 80% of the volume took place up here. That's probably bearish, right? People are selling. But when you calculate the Chaikin and the OBV and all that stuff, this is just going to say, was it an up day? Yes. Was there volume? Yes. Bullish. So again, it's like you're placing emphasis on a dependent variable where price is what I would argue is the most independent variable. Now, that's not to say that volume isn't useful or volume should be ignored. It's just that if you had to pick one or the other, price absolutely is the leader. And then you have to always use grain of salt because the volume can sort of be misleading in the way that I described, a high volume up day where in reality there was mostly sellers. What am I looking for? I actually just made a volume indicator that I don't mind sharing, but I'm not going to put up right now, which is, I can give you the premise for it. It's pretty simple. Basically, it's just the close times the volume. And what that is that's dollar volume. So instead of the volume being like in, whatever, like shares, denominated in shares, I guess, this is denominated in dollars. So if we go to Bitcoin right now, we can see that instead of this reading of, what does it say, 1,300 shares, who knows what that means, we know that this bar had, it looks like, $25,000 and let's do default 0. There we go. Not 25,000, 250K. So is it easier to know that this bar had almost $2 million of activity, or would you know what I was talking about if I said 7,700 shares? So this might be a way to use volume that doesn't change the nature of the data, but to me makes a little bit more sense, because you could say, man, look at all the money flowing into Bitcoin. How do I know this? Well, look, we've got a very wide-body bar. There's no wick, and there's higher volume. Okay, I can infer that's better. That to me is a much more straightforward way than if you do an OBV, you're just essentially going back, you're smoothing the data, you don't know exactly, like, I don't know. I mean, again, if it's helpful, then it's helpful, but it's not my cup of tea.
Yeah, Sonny, did that finish your thought?
Yeah, that doesn't.
Okay. I mean, we put together this Google Doc, and there's a lot of kind of, tangential topics as far as trading psychology and stuff, but I think we've stayed really focused on, what people are here for, and it's the SCMR trends, and you've done a great job of that intro, and which is good because I've yet to really have a formal intro to your product. And I think I finally got it.
Yeah, no, that's funny. There was someone else that, another person who was like, when I showed him something, I'm like, hey, you see this? He's like, why didn't you show me this the first day that I got this? And I was like, I don't know. There's lots of ways to skin the cat. But one thing about psychology is the thing about the risk management is if you incorporate that and you decide. Remember in my PDF, we were talking about how different sizes would lead to different min or max returns, where if you did quarter Kelly, in 98% of the trials you broke even. Well, what if you double that? Then you can see that your returns get huge, but your odds of ruin also go up by a lot. Maybe that's you, and you can do that. So I think the whole point of that was that psychologically, if you can go to bed at night saying, listen, I'll take 100 trades the next 2 months. I can be 70% wrong, and most likely I'll be somewhere around break even. That gives you a lot of latitude where if you are any more accurate than 70% wrong, that you'll be making money. And that's like the whole point. And then there is no cookie cutter structure like just sit back, smoke your Cuban cigar, and do this and you'll be rich. You have to use a feedback loop. You have to go in, you have to see your results. You have to say, gee, this strategy actually worked really well right here and it worked really poorly over here. Is there anything I can do? It's a feedback game. It's like after the game, you watch the video showing what you did, you know, as a sports terminology or sports. You know, it's the same thing. You don't just like box and then say that's it. It's like you spend 15 hours reviewing your boxing match to see where you could have improved. Same thing, and there are no shortcuts. The whole purpose of this is to make some of your life easier. You still have to review, you still have to manage your risk, you still have to pay attention, but instead of being so hyper-focused on, is this a short, is this a short, is this a short, is this a short, is this a short? If you want to trade that pivot, it's like, okay, well, here's a pivot bar, this all things equal is going to be a better short, or whatever the case might be. So in terms of psychology, we probably could have talked as much about that as hypothetical other setups to take, but again, if you're looking for the confidence boost, take the confidence knowing that you can be pretty wrong if you follow the Kelly betting strategy and the optimal sizing, and then you add in anything that improves your accuracy, such as the trading setup that I showed, then you're actually sitting pretty nicely. And you know, you can see that like in terms of the trades that I like to take right now, this is a great market for it. I trade stocks, and you know, we had a little bit of chop. Now the market's generally going higher. These types of plays, the BDCs of the world. One of my clients who's actually just kicking so much ass lately, he did the same thing where he basically longed this right here, sold into that. My favorite oil and gas stock that is defying logic. I mean, it's pretty easy when your job is to identify opportunities like this. You know, not a lot of rocket science there, right? But that's like you get the right Kelly sizing, and this, it's just, you know, it really makes your life easier in terms of like, what am I going to do to find good risk reward, good entry exit, all that jazz.
All right. You know, I still want to try and keep it to 2 hours total for this. We got probably about 10 minutes left, but I just wanted I got three big topics, or three small kind of, I should say, like machine gun topics that I'd like to cover, and it's going to be, I'm just going to list them, and then we can go over them in sequence. So it's the color of pivot candles, alerts, and I'll elaborate on that, and then future products. So unless I just completely missed it when you were saying it, can you go over why some of the pivot candles show up orange or purple and stuff like that, and what the significance of that is?
I wouldn't worry about the significance. They're just different types of pivots. So the orange pivot will only come in after an uptrend, some type. The other pivots will come in anywhere. And basically the main point is that you're expecting a pivot. So if you look at price coming up and then it comes in, pivot doesn't always mean that price comes down. It just means that this is an area where it should move away from. So I tend to use the same logic as the first green candle bar. You say, look, this is the lower end of the pivot bar. This is the upper end of the pivot bar. I expect some movement away from this zone. And same thing over here. Same thing over here. So in this particular case, you know, it worked out pretty well. You never really broke down to the pivot zone. You ended up breaking up. You know, if you look at the intraday time frame or whatever, there's going to be a lot more pivots that you'll find where it's like, here's a pivot that moves up marginally. Here's a pivot that kind of just moves away. Here's a pivot that comes down. It's really just for identification purposes if you want to take that trade. Like I said earlier, I tend to not take those trades as often because I don't have a framework for what the right risk-reward size is. Sometimes it's huge, and other times it's not so much. So net, it will work out in the end, but the simple just trend trade is what I like. So that was your question number one.
Yep. And then into question number two, not to get too systemization aspect to you know, the trend product, but is there a way, like I know TradingView has an alert system.
The alerts. Yeah, I'm going to be offering an upgrade with just a couple minor improvements, and that will be one of them. If you go into the alerts right now, it gives you so close, you know, because you can say, I want this value to be something on the dynamic levels or the trends, and you're like, oh, awesome. But the problem is that it's going to say crossing, you know, they're looking for a value, not like crossing some state. So I'd have to just work that in, but short answer is no, there's no alerts yet. I use other software that is fully scannable and offers alerts with all my products. So that's how I can find an opportunity in real time. Unfortunately, because TradingView doesn't have scanning and sorting, you'd have to do it basically manually.
Sure. So then that just segues real nice to, and like what are we seeing? This is a lot to digest for even me who's been actually using your product. Now I know how to use it.
Yeah.
And now we'll just say like what improvements are you rolling out, additions onto the SCMR, and then just future products in general that we can kind of look forward to.
Well, the bulk of the research that I did in testing this and developing this was doing the sequence. So the sequence I'm pretty satisfied with. That will remain unchanged. Some improvements are I'm going to add in a way to slow down the count, so that way you can slow the trend down. Because normally if you want to slow the trend down, I would say just move to a higher time frame. Here it's like green, 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 red, 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 green, 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 green. If that's too slow, then zoom in, and then now you'll get green, 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 red, 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 green, green, green. Fine. But it might be nice to stay on a 5-minute chart, but have it plot the 30-minute trend, something like that. So I think that would be a cool upgrade I'm working on. The other one is some people have been using Heiken and Ashi bars as sort of like a hack slow down the trend, because of the way Heiken and Ashis are calculated. So you can see that this looks very nice, green, red, green, etc. I have no problem with that, but it messes up the dynamic targets. So what might be useful is getting a Heiken and Ashi overlay on the actual trends. That would be another thing. So when we come into the trends right here, there's checkboxes to show the pivots text, so we can turn on or off these O's and these reversals. And that will just be another checkbox. It will be like use higher time frame, and then you can type in 30 if you wanted the 30-minute time frame on the 5-minute chart. So that will be that. I'm hoping that TradingView offers scanning and sorting. If I can bring you into another program that I use, this is a little bit miscellaneous, but you'll like it. I can practically assure you. This is where I do most of my scanning and sorting based on the software. So if this will load. This is just like a little bit of an aside as to what TradingView I hope will be bringing in the future. Here you can see basing at high, first bar to bar up. So when we click this list, it's going to show all stocks that are basing at their high and doing a first bar to bar up. So when I went back to that bread and butter setup that I like, where it's just kind of a mellow uptrend with some sort of basing, this is where I'd be getting my ideas from. So you say, oh, this ADP T, I like that, or whatever. Hopefully we can be doing this all within TradingView in the near future, where you say, whatever what I'm looking for is. So this is going to be coming because all of this stuff is programmed differently, even though it uses the trends. So I'm going to be adding that in as part of the suite on the basis that, with the assumption that TradingView is going to add the scanning. So you can say, not only do I want to scan for a green bar, I want it to be the first green bar, and I want price to already be rising, and blah, blah, blah. So it's almost like a take-home package where you can just say, this is the setup I want, and here it is, and then there it is in a list. That would be the ultimate ideal, rather than having to fish through 100 stocks to find the one with the first green bar or whatever.
I gotcha. Yeah.
Another question, if I can go.
Go ahead, Gavin. Go ahead.
My only other question is, do you change the way you use the tool for any specific types of markets, or do you always use it the same way? I mean, it seems really effective for almost anything, but when you're trading a stock versus Bitcoin versus this, are you changing your style a little bit?
No, I've used it the same way each time, basically. What I will say is that this was designed for stocks. It works best on stocks, and the reason why is because when you are looking at a sequence, as in price going up, price going down, there is often an economic basis for that. So let's go back to, really quick, let's just go back to this example. I think this will be helpful. We're going to go back to my dollar volume example. think this will explain everything. When a stock is going up, there has to be some economic reason for it to go up, and then usually the most likely reason is that there are buyers, right? That's pretty straightforward, like no duh. So when we look at the dollar volume for this very small company, we can see that today there was
Do you want to share your screen again?
Oh, is it not?
Yeah, we can still see you.
Oh, okay, good. All right, so I'll full screen this. So look, each one of these things is the amount of cash that went in and out of the stock. It's a very thin stock. Look, $2 million traded at these bars, right?
We still aren't seeing your screen.
Oh.
Yeah, you're on camera. You can switch on camera.
Okay. Let's go back to here. And screen share entire screen.
I think it's coming now.
There we go.
There we go. Yep.
Hope it wasn't like that the whole time. Yeah. So anyways, here we are. $2 million of dollar volume. That means $2 million of cash. So let's put ourselves in a hypothetical scenario where a portfolio manager wants, 5% of his fund in this company, and he runs a $100 million fund, which is small by almost any standard. That's $5 million that he has to buy of this stock. Well, you can see that if he absorbed all of the trading volume in a given day, he would be pushing the price up too much. So he might get in there and buy $200,000 worth per day. Well, that's still going to take him 1 month to fill $5 million worth. So when you see a stock going like this is the physical manifestation of some guy going in there, buying $100,000, buying $100,000, buying $100,000, buying $100,000, buying $100,000, until he has his $5 million position in this hypothetical example. So that is the economic basis for why something will trend in the market. And Bitcoin has a similar rationale behind it. When we go to something like Forex, 85% of the Forex market, and this is according to the Bank of International Settlements, so I trust their data, is merely forwards and swaps, which is basically interest rate offsets, or hedging. So interest rate offset is you can borrow in one currency and swap for another with a higher yield. And risk mitigation is you got Volkswagen, which is a German firm. Volkswagen has auto dealerships in America. They sell cars in America. For IFRS, which is the International Accounting Standards, you have to basically translate from your functional currency, which is US dollars in America, to your presentation currency, which is euros in Europe. So we have a European car firm that sells in dollars, accounts in dollars, converts to euros, blah, blah, blah. The last thing that they want is some sort of a, FX, what's the right word? FX problem on their income statement and on their balance sheet. That affects their bottom line, especially when you have something like the euro going crazy. So they are out there buying and selling and buying and selling for no economic reason, like this is a good value, this goes up, this goes down. It is strictly an accounting purpose. It is 100% to satisfy an accounting equation on the income statement, on the balance sheet, that has to do with what their sales are in a given location. So since that is 85% of the FX market, what that means is that with the exception of like the euro in this particular circumstance, because that is a major dislocation for other reasons, some move up or down in the Great Britain pound, Australian dollar is like practically the definition of noise. It's so much harder to determine the economic basis for that because you don't know if it's just a currency transaction for interest rate purposes. You don't know if it's some sort of balance sheet accounting thing. It very rarely has to do with the fact that there's a guy sitting there going, the Australian dollar really is undervalued compared to the Great British Pound. I'm going to, that is like practically impossible to tell. Whereas when you see something like this, it's almost never for anything except for the fact that there's a guy out there who's saying, I'm going to buy $100,000 every single day until I have my $5 million position. And this is a tiny stock. Even if it's something like Apple, it's going to be the same thing, but they're going to be saying, you know what, I'm going to be buying $5 million every single day until I have my position. Or whatever the case is going to be, same deal. So that is why there's an economic basis for these moves in stocks and in Bitcoin, because Bitcoin's the same thing. Like no one is really saying, I'm going to hedge my US dollar exposure with Bitcoin. It's too small of a market, no one cares. They're going to say, I want Bitcoin exposure because I think that Bitcoin is going to appreciate here And Bitcoin, for that reason, largely trades like a stock, and that's why I like it, among other reasons. So stocks, yes. Bitcoin, yes. FX, personally, I will never trade. Don't recommend anyone even bother for the reasons I outlined. And then currency, or not currencies, commodities is like somewhat of a gray area in between. So if you like trading FX, don't think I'm, talking ill of your whatevers, but there is like a reason why it's a less good market, and that's what that is. So how do I trade this cross markets? Essentially, I don't. I trade stocks, and I stick to my bread and butter, and that's it.
All right, Gavin, did that answer your question?
Yeah, that was about it. I was just curious. It's good to know.
Yeah, I know that was sort of a big answer to a small question, but I do get that one a lot, and I think it's important to explain why I think Forex is such a bad market, and hopefully that sort of gave you some insight as to why I believe that. Of course, there are guys who make their living trading Forex, so that's great for them, but I don't like it for the reason I explained.
All right, so let's wrap it down, or wrap it up right here.
We'll break it down. We'll wrap it up.
We'll do whatever, but I want to make sure that people can get in contact with you, especially if they have other questions. I did have a question about the momentum indicator, unless you want to just touch on it very quickly. But
yeah, I guess I can. Basically, the momentum peaks is largely designed for trading stocks. That's like the original purpose. So if we look at this particular company, Belden, which is just something that's fresh in my mind, and we add the momentum peaks over here, what it's showing you is momentum on two different time frames. So this is long-term momentum, dark green, short-term momentum, lime. Long-term bearish momentum, this pink color, short-term bearish momentum, red. So what I noticed, which I don't think is too scientific, all things equal, is just if you sort of create like a threshold for stock momentum at 30, a totally arbitrary number, feel free to pick your own, but let's just find 30 right here, and let's just draw like a line that says above 30, below 30. And yes, this number is specific to stocks, and yes, you're gonna have to find whatever the magic number is and whatever you like, but the point will be the same. Is like, look what happens when the long-term value goes above 30. If we were to sort of like just box these areas, so long-term is coming above 30, right? So this would be that zone somewhere in here. Long-term is coming above 30, so we're talking about this area. The whole point is that if you are looking for like where is a better time to trade momentum, it's going to come in these higher value areas. Do you see that? Now, if we come into something like Procter & Gamble, when we zoom out and look at the big picture, is a low momentum stock. It's, Procter & Gamble. So you can see it doesn't even get to 30. We could maybe apply the same rationale at the 15s, but, when we're looking at something that's going up a lot, I use that 30 threshold. It looks like I already did that on this chart too, to basically filter. So here's 30. We've drawn our little arrow that just is like above 30, below 30. Again, no science to that. You can pick any time frame, any number, and sort of arbitrarily see what looks best to you, but there is some basis for it. We're under 30, stock's choppy. We're above 30, look, it's trending. We're under 30, it goes sideways. We're above 30, trending again. So if we went to a 5-minute oil chart, and we did that same thing, okay, I'm going to delete all this stuff. Then what you would find is it's the same. Wow, look at that move. Nice one. So
is that crude oil today? Yeah.
Yeah. So we're looking at a 5-minute chart. We can do the same thing on the upside or the downside, and we could just say, well, the stock's going down, whatever, it's going down, not the stock, but if we look at where these areas sort of get like, so see these blue lines? The blue lines are meant to guide you in where you should be drawing your little magic arrow that, at the 30 value for stocks or for this particular commodity. Let's say that it's, see, I'm just connecting the dots on like the lower part of these blue ones. That's all it is. It's a filtration method. So we say, okay, look, it's underneath this area, a lot of downside momentum. It's underneath this area, a lot of downside momentum. So it just helps you identify momentum versus chop. That's how I use it. I spruced it up a little bit for the suite to kind of add in a little bit more, but I think for the time being, that's all it's really worth mentioning. These like, overbought, oversold areas, but I don't really like that term, and it's easier just to say downside momentum is very high, right? Upside momentum is very low. Does that make sense to you? Is that something you sort of are seeing what I'm saying?
Yeah, I'm slowly incorporating it more. Just it always helps because now we're actually having some formal tutorials on this. I feel like before it was kind of like this patchwork quilt that I've been working on for the last 3 months.
Yeah. Well, it's simultaneously easy and complex because once you start to get the hang of it, it's very simple. It's like, okay, I know what this means, I know what that means, I know how I'm going to act. But when you first look at it, it's like you could kind of be doing almost anything, right? Am I targeting here? Am I getting long here? Am I looking at this? So I understand that it's there's a little bit of a learning curve, but I make myself available pretty much 24 hours a day, either on my Twitter, which is SpyderCrusher, don't forget the underscore, or you can email me at SpyderCrusher@gmail.com, or you could PM me on TradingView, and pretty much whenever, if someone does use my software, then I get a notice saying that they are. So I usually initiate contact with them through PM or Gmail just to make sure that things are going right and thank them for, their interest and etc. So anyways, point is you can always reach out to me. You too, if you need something. So
Yeah, I mean, you just covered exactly what I was going to ask. Is that's how they can get in contact with you. You're very accessible. You're on TradingView a lot, Twitter. Hopefully a little bit more on TeamSpeak, because.
yeah.
But if you find some time, we'd love to have you there.
Oh, absolutely. I always enjoy chatting with you guys, and it's fun. It's a good crowd in there. So shout out to all you guys.
Yeah, thanks for that. I am actually going to review some of the videos as soon as we get off, because there was so much to digest there, but I have to go back to a few parts. But I just want to thank you for coming on. Thanks, Sonny, and all the people over at TeamSpeak that have been listening, as well as TradingView chat. So with that, I'm going to go ahead and sign off. Thank you guys all.
All right. Thank you.